Hey, Stephanie.
Hey, everybody. Welcome to week 122. And we have the amazing Stephanie Daniel, who is taking the place of Jack Santiniello. And I said to Stephanie before we went on air, I said, man, I'm so glad to have you. And she said, well, you don't have to lie. And I said, no, anytime that we get to do a free upgrade, and she goes, well, the bar is pretty low with Jack.
But he did nominate me for officially saying, look, where's your Tar Heel gear? I mean, this is ridiculous. Like, you didn't come with your whole Rams head. And she just clicked off. I can't believe she just signed. Just kidding.
The abuse.
Look, I got to double down, Stephanie. My daughter is now one of the personal trainers for the football team. So she's in training camp right now with all these. She's the running back's personal trainer or physical therapist. So if Duke beats Carolina and it's because their running backs suck, indirectly it will be her fault. So there you go.
Oh,
my pleasure.
Man, that's
anything
rough.
I can do. Anything I can do to help that.
Oh my goodness. Well, so we'll get into and we'll pass the torch back and forth with Stephanie and Adam. There's plenty to talk about today, as we're going to be talking about the Inflation Reduction Act, which that is such an oxymoron. I mean, if you just look up the meaning of reduction and what is in this bill, and I'm not sure that they understand the meaning of that, but I am wearing the Charlotte FC jersey that I wore last night.
3-0.
Thank you, Derek Painter and US Bank for hosting me and my neighbor, Chris Mahalik. We had a blast at that game. And anytime that you slack an opponent 3-0, it's a really fun game. But those games are just a riot, especially if you're in the fan section, but you will come out smelling like beer and wet from all the beer. But it is so much fun. So thank you, Derek. I do have a poll towards the end of this podcast or this webinar that has to do with Charlotte FC's secret to defeating DC United. And, pay attention because we're going to need your participation for that. So that's just good things to come. So Adam, before we pass it over to Stephanie, anything that you wanted to address while I got you here?
Yeah, just a couple things. First off, on the topic of inflation, if you guys get a chance, Mike Collins, who's the 9 a.m. host on NPR here in Charlotte, had a pretty good session, not yesterday, I think, but the day before, with Mark Vintner and a few other economists, that I thought was one of the best kind of breakdowns of what's going on and what we can expect. And I'm pretty sure they post those on the NPR website. And I think the thing that stuck out of me on that one is that, I don't know. I mean, Mark Vintner is normally, a lot of us that are Charlotte, fixtures, know Mark Vintner, and that he's normally like the most positive economist on the planet. And he was not like super, super positive, on the session in terms of like, hey, how this potential recession will feel relative to other recessions, and I'm not saying that to say, hey, it's all doom and gloom, because I'm not. I think that, as we've seen at BGW, that, people that are generally, pretty healthy or in the process of getting themselves healthy from a balance sheet and income statement perspective, do just fine. And in fact, periods of recession are actually great for them. It's like the classic Warren Buffett. I buy when other people are fearful. It's like I go out and attract customers when other people are retrenching from the market. It's like, it presents a good, business opportunity, but at the same time, I'm a big fan of the ostrich analogy. Like, hey, if you're like one of those, business still seems good, it's gonna be fine. Like, hey, how we doing up there? oh, you know, don't do that, because these are people who are normally relatively positive people that he had on the show, and they were not. Basically they're like 2 to 3 years of ups and downs. I mean, was kind of the punchline, that came out of it, with likely, continuing higher interest rates, was sort of the punchline that I took out of it. So just, I guess my takeaway from that was, continue, even though a lot of our clients have not experienced anything, that's like haven't experienced anything yet, would be the key word that I would put after that. So, I think not preparing, this is, I always say going to the grocery store when it snows here and milk and bread's cleared out. It's like, it seems a little overkill, but this is sort of like, at least have a damn flashlight in your house. It's like a basics of preparation. So if you get a chance to listen to it, and then I'll, as we get into it, I'll make a comment on the Senate, the proposed Senate bill that may or may not pass, coming up here.
Yeah, that sounds good. Yeah, the milk and bread thing is really an interesting phenomenon, because especially in the summer, like, okay, so if a hurricane comes through, and we've had our home damage from hurricane, and you go without power, what's perishable? Milk and bread. So I'm like, oh man. Anyway, so Stephanie Daniel is with us from Shumaker. And I love her title, because it reminds me of when I was at Bank of America, we used to say, why use one word when three will do? So her title was like, she's trust and estate planning forte in the legal world. She's a partner there, but her title is Wealth Strategies Regional Service Line Leader. So I like it. But she could go deep on this subject that we're talking about, and like, what should we be doing? So it's really good to have you here, Stephanie, even though your allegiances may be misaligned. I don't know. And I don't have a dog in the hunt. I'm from Kansas. So
Well, at least that's the right shade of blue.
well,
Oh boy.
Oh yeah. Well, I went to Kansas State, so you mix red and blue and you get purple. So there you go.
Yeah, you should see my new business cards that they had to give me once they gave me that new title. It's like I'm carrying around one of those big publisher clearinghouse checks with my business cards. So I just leaned it up against the wall. I don't even carry business cards anymore. So thank you for having me. I'm kind of here to talk a little bit about the Inflation Reduction Act of 2022. What should we be doing? That's a really good question. Let's start there, and then we'll go into what we know about the act. That is like 800 pages long, 725 pages, I think, is how long the act is, the proposed act. But that's where we'll start, is what should we do? And that's kind of nothing right now, because I don't know if anyone remembers last year. I certainly remember last year when we had the proposed Build Back Better Act. My clients were going insane, because there was talk of reducing the estate tax exemption from what is now in 2022 just over $12 million down to $3.5 million. And so there was a lot of anxiety, and Tums probably was being sold out in Walgreens and CVS around the city, around the world, because around the country, I guess, because of that issue. But I think that taught me a little bit to sit and wait, because nothing happened with Build Back Better. It was not passed. And so it was a good impetus to get some of my clients kind of entrenched to do some estate planning with the specter of the passage of the act. But I think that teaches the lesson that we can't run around screaming the sky is falling all the time. And the sky never fall. And so I think we just have to kind of sit tight and keep our eye on this bill. There's nothing in this bill that's currently proposed that is remotely like the Build Back Better Act. So we don't have any huge income tax changes. We don't have there's no estate tax or estate and gift tax changes proposed in this bill. So the primary things that are focused on is establishing a corporate minimum tax. So the proposed bill would impose a 15% minimum book tax, to be defined, on corporations that report a 3-year average annual adjusted, that's a lot of A's, average annual adjusted financial statement income exceeding $1 billion. So the tax would be imposed on both public and private C corporations, but not on S corporations, not on REITs, which are real estate investment trust, or regulated investment companies. And the Democrats say that they anticipate this provision would only apply to about 20 companies. And you might remember last year, the global initiative to institute corporate minimum tax. This is in some degree responsive to our commitment to that proposal or that arrangement. And so that's where this is coming from. Corporate minimum tax of 15% for companies with annual book income of exceeding $1 billion.
Yeah, and to put that in context again,
Yeah.
I mean, we talked about this probably about a year ago. On the one hand, you're like, oh, geez, I mean, it was, companies like Duke Energy, love Duke Energy in our backyard, big employer. They did things fair and square, followed the tax code, did what they were supposed to do. Geez, this would really hit them, as one of the offenders of makes a lot of money but doesn't pay any taxes. The flip side of that is, to put that in context, I will be dead before Duke Energy has to pay taxes under the current regime, because they have 50 years of built-in deferred losses to apply to and credits to apply to future years of income. So I will be dead before they've run through their tax attributes. And I'm only 48. So I'll be dead before they burn through their tax attributes. So, man, it's hard to argue against this one in some respects.
Well, the next one is the one that's not hard to argue against. It has been a sticky subject for years. It's been in proposals again and again and again. And I actually think this is the deal killer. I think this is the thing that doesn't get it over the finish line. And that's the proposed changes to the carried interest rules. So the bill would amend the carried interest rules to increase the holding period from 3 years to 5 years for taxpayers with adjusted gross income of more than $400,000, before the taxpayer is able to receive long-term capital gains treatment on carried interest in certain partnerships, such as hedge funds. So when I saw that the carried interest changes were in this bill, I was actually a little surprised, because Senator Sinema from Arizona has consistently objected to the modification of the carried interest rules. And Senate Majority Leader Chuck Schumer has also appeared to be against any modification of these rules. However, this shows what Senator Manchin's stunts over the last 2 years have gotten him, is the ability or the power to have this included, because he said he will not support a bill that does not include a change to the carried interest rules. And so that's where I think this falls apart. I think that there may be 1 or 2 Democratic senators who pull a Joe Manchin and say, no, I'm not going to vote for the carried interest rules. And so then Joe Manchin's going to pull out. And so that's what I think is ultimately going to be the demise of this proposed bill, is the carried interest issues.
Yeah, and for the people that are like, I don't even understand what that is. I mean, this is basically, if I'm a private equity fund, I'm accruing management fees and earnings that I'm not actually getting paid, as I'm holding my investment. So I buy BGW, and I'm holding on to it and charging BGW a tax for owning it, which is this carried interest number. And, right now, that tax for owning the company that I'm placing on BGW is considered capital gains treatment if you hold it for long enough. And the argument against that has been, well, like, isn't that what you do for a living, private equity firms? Is buy companies and, kind of hang on to them and run them, in exchange for a management fee. So like, isn't that supposed to be ordinary income? So the first compromise that happened was at least taking it to 3 years. And I think that was part of the Tax Cuts and Jobs Act, if I'm not mistaken. And then this would take it a further. So at least there's some acknowledgement that there's some ordinary income in here somewhere, and this is simply taking it from 3 years to 5 years. And I think, whether it's right or it's wrong, I mean, I think if you probably looked at the average private equity transaction, 3 years would be a pretty quick flip. So there's a lot of them that are kind of escaping this concept on the 3-year number, because most of the shelf lives of a private equity investment are going to fall in kind of that 5 to 7 year time frame. But that in a very layman's definition is what carried interest is.
So the next thing that the act does is increase funding to the IRS. So the bill will increase funding by approximately $80 billion. And the breakdown for that is $3.1 billion to increase IRS taxpayer services. I know all of us deal with the IRS all the time. I'm not sure how much services they provide, but $4.7 billion for IRS enforcement, $25 billion for IRS operation support, which would be helpful so my paralegal doesn't have to sit on the phone for hours on hold. And $4.7 billion for IRS technology upgrades. So that's how that $80 billion shakes out.
Yeah, and I'm, again, we've had a lot of clients have been like, oh man, what does that mean for me? It's like, my answer has been, for our clients, nothing. I mean, that you generally got nothing to hide. Like it may increase the frequency of the audits, but it doesn't mean there's going to be more findings, because we don't generally have stuff to hide. But to echo Stephanie's comment, I mean, like literally, there is a secret line that Stephanie and I can call, called the IRS Practitioner Priority Hotline. Right now, if you call that hotline at any time after 9 a.m. in the morning, they will not even pick up the phone. The response is, we're too busy, call back later. I don't know when later is, but like 2 years ago, you called that line, kind of your worst wait time was maybe 30 to 45 minutes, which was awful, but at least it was better than calling the general line. Now you can't even get through if you call after 9 a.m. I haven't tried at 8 a.m. yet. That's my next move, but I mean, this is not awful. In some respects, it's someone who's in the business. And secondly, I mean, there are just generally a lot of people who just don't even file tax returns that made a lot of money that needed, it's like, if you're the person that, hey, I've got $1 million of income coming, I've got $1 million of cash coming into my checking account, and my tax return says 0 on it, in no way that's supportable, you should be concerned. That is not our client base. So.
And if that is you, don't call us. We're not going to take you.
Yeah, right.
We'll call you for a referral to someone else.
Yeah. Do we cheat them and how?
That's right. And then, finally, this bill has a huge component regarding energy provisions. And that's what the title should have been. It should have been something energy related, because that's ultimately what they're driving at. So the bill includes a substantial package of energy incentives as part of the climate change initiative. It extends the production tax credit and the investment tax credit for investments in energy and qualified energy companies. And it introduces a new clean vehicle tax credit, which somewhat encompasses the prior plug-in electric vehicle credit. But then I won't go into all of them, but there's a whole slew of energy incentives in this bill. And that's really what some of these changes to the income tax issues that we've talked about, both the corporate minimum rate and the changes to the carried interest rules, are really targeted at paying for, is all the energy incentives that are included in this proposed act. So ultimately, the bill is projected to raise $739 billion, $288 billion from drug pricing reform, and 451 billion from the new tax changes. The bill would spend $433 billion on extensions to the Affordable Care Act and energy climate change proposals, and more than 300 billion of the revenue is going to go to reduce the deficit.
Yeah.
Yeah.
So
I mean, go ahead.
I was going to say, I think the scoring office said like it was a 0.5% reduction in inflation over a 10-year period per year. So it's, Gary is correct. It's not really an Inflation Reduction Act, other than you could kind of get there with the, yeah, but if we're giving people tax credits, that's going to make the pain of inflation a little bit less painful. It's like, okay.
Like watching paint dry, right? I mean,
I know, it's like, really? So, but I kind of would echo Stephanie's comments that it generally represents, when if there could possibly be good news, around something like this, this is probably, if there was going to be some tax reform, this is probably as good as it was going to get out of this administration in terms of not having a negative impact to our tax rates and otherwise not driving us deeper into debt with things that we can't afford, just based on, the CBO. I haven't looked up on taxfoundation.org to see what they scored it at, and some of the other conservative groups see what they scored it at. But generally, if the CBO is minus 300 billion, then even the most conservative are still going to have it, like, probably worst case being neutral. So that's generally fairly positive as a U.S. resident, not advocating for or against the bill, but it's generally positive as a U.S. resident to see something that's neutral, if not slightly positive. Especially if somebody's having to pay their fair share that otherwise wouldn't have to pay their fair share until I'm dead.
A couple things worth noting, and Adam, I want you to expand on the second part of this, but the first one is, so for anybody that's planning on rushing out, if this thing passes and cinema goes along and they all sing Kumbaya, which, you're probably right, Stephanie, somebody's going to throw a grenade into this thing, but let's say it went through. So everybody that wants to rush out and buy a new Ford Lightning pickup, which there are people on hold for that, it sounds like a pretty cool vehicle, or the Tesla Plaid S, man, that sounds great, 200 miles an hour, and lots of giggles at $126,000 plus. That's before the inflation keeps kicking it up. It'll probably be 200,000 before you know it. But there is a limit on the claim on that electric vehicle credit. There's an AGI limit of 300 grand if you're married, 225 for head of household, and 150,000 for single filers. So just saying, you might want to be aware of that. I would like you to go and pontificate a little bit on this one. Increase of 250,000 for the R&D credit that can be applied to payroll taxes for qualified small businesses. Any thoughts on that? Because we see R&D tax credits are missed a lot. When prospects come to us, we'll do an analysis of where they're at, and oftentimes they have qualified for R&D tax credits, but they have not taken them.
Yeah, well, so there's two components. I mean, one component would be I qualify for the R&D tax credit, but I didn't know it, so I never actually claimed it. But then I think where this is really targeting more is that, you qualify for the research and development credit. So who's going to qualify? A lot of startups that are tech heavy or manufacturing heavy or like product, R&D heavy in the beginning. Well, what do they all share in common? They have a bunch of freaking losses. So in the past, even though you generated a bunch of tax credits, they only applied to positive taxable income, and it had to be specifically positive taxable income related to R&D type activities. So what this helps with is the ability to actually use the credit that you earned against other taxes, so to help, basically finance future R&D. So I'm for I'm for something like this, because it gets very frustrating to see clients have, that are, really out there trying to make something happen, ahead of the curve in terms of what they're doing. And the market's just kind of starting to wake up and catch up to, buying their product. Cause like no startup ever, beats their demand curve. We thought demand was only going to be X, and instead it turned out to be Y. In the first 2 years, that's the exact opposite. It's like, well, if only these idiots would wake up and realize how beneficial this would be for them, I'd be doing a lot better. And they start to hit cash flow issues. So yet they've got hundreds of thousands of dollars of tax credits to offset the labor costs that they had to invest in this R&D, that they can finally have a chance at using.
So, Stephanie, I'm going to throw this one to you. And this is a question that came in from Robert Mayetta. He has some of the best questions, and we don't always have answers for it. And so we may not have, this is a bit of a twist. So any highlights from the CHIP Act that passed Congress that is noteworthy? I actually found a summation. There's a 5-page PDF summation of the article that I sent to Robert, but anything that you want to weigh in on that one?
Yeah, I haven't. So that's the CHIPS Act. That's the semiconductor creation of semiconductor chips and investment here in America. Because clearly we saw how many problems were created by the fact that all of the chip manufacturers are in Taiwan. And don't even get me started on Taiwan. I read an article in the New York Times about that whole fiasco. And I would recommend, I just finished Ken Follett's book, Never, that really focuses on the dynamics. But I don't know if anyone is a Ken Follett fan, but it's a fictional book, but it focuses on the dynamics between the US and China potentially being the next World War III. And with what we're seeing with this this thing that Nancy Pelosi pulled going to Taiwan, we may be very much closer to something like that. So that just because I've recently read that scares me to death. But the CHIPS Act, just really focuses on the fact that we need to be making semiconductors here and not be so reliant on, other markets to do that. I have not, to be honest, I have not examined that, so I'm not sure I can give any meaningful summary of that. But I mean, I think that is something that I am glad that we're addressing that, because it's something that, we've just seen such a crisis with US manufacturers not being able to get the semiconductor chips that are needed.
So if anybody wants to go deeper on that particular thing, I found a summary and I can put that in the chat. I think I will put that in the chat. But it was, hold on here. Yeah, if you want to go to it, it's www.commerce.senate.gov, and it has a pretty good overview there. And like I said, it's not 720 pages, thank God, but it's like 5 PDF pages, so you can kind of go through it. So we did talk about that a couple of weeks ago when we had Ben McDonald on here, because at that time Pelosi's husband had just sold a bunch of stock and bought a bunch of NVIDIA stock, and that was like highly questionable. So we did talk a little bit about can we? Evidently, there are funds or whatever that just follow Paul Pelosi's trades.
Yeah, there's a Twitter feed about it. Yep.
I may have just lost my audio.
Oh,
can you hear me okay? Okay.
Yeah, we can hear you there.
Yeah.
All right. I lost you, Stephanie.
All right, I'm still here.
All right, good. All right. Well, we've got a good crew of people on here. You've got a couple really wise experts. And like I said, we did an upgrade on Jack. So you might want to take advantage of this upgrade with Stephanie on the line. If you guys have any tax or legal questions that you're wondering about, especially in these inflationary times, looming recession. Well, we're not in a recession because they've redefined what a recession is. So that's good news for everybody. all we have to do is keep redefining what is, and then it'll all be good. So if anybody has any questions, oh, go ahead.
Gary, yesterday you sent me, someone had a question about the Secure Act and the proposed regulations to that. I'm happy to talk about that if anyone is interested in the IRA required minimum distribution changes.
Oh, that's a good one. So this question is for you, Stephanie, from Robert. Is your expertise in estate tax planning?
Yeah, so that's what I do is trust and estates is what our group used to be called before we renamed it Wealth Strategies. So I do everything kind of soup to nuts in the estate planning world. So whether that is estate planning and drafting documents and creating plans for clients, to estate administration when someone dies, trust administration, and fiduciary litigation, which is really it encompasses a lot of different things, but it can be trust modification work, it can be guardianships, it can be litigating disputes between beneficiaries and fiduciaries. That happens unfortunately quite often. So yes, that's kind of what my role is with the firm is trust and estate work.
You know, one of the things that we've seen, and Adam mentioned this earlier in the broadcast, which was, hey, you know, especially in recessionary times, those who have kind of their ducks in a row, and it doesn't mean that you have everything perfect, but the fact that you've got a succession plan in place, you've got your books in place, they're not a train wreck, you have less roads leading to you, et cetera. Well, those are all really good things because you can move and you can pivot a lot faster. And so what I would encourage people to do is just make sure that you are battening down the hatches and engaging your team now. Roddy Player was on our podcast a couple of weeks ago, who owns Queen City Appliance and Audio, Visual, and Appliance. And it's now third generation. His kids are now the third generation, but 70 years in business, and they had to pivot really hard, especially during COVID. Especially think about retail, you know. And he went to his team. He had a good team in place. He had good systems, but they battened down the hatches because they had at one point during the Great Recession 70% loss of all their business. So think about that. 70% of your business is gone within a year. And so that's painful. They remembered, but he went to his team. And so I just encourage you, take baby steps and move and engage your team, because his team and it wasn't just him as the great man coming up with the great idea from on high. He actually went to his team and they said, hey, we think supply chain is going to be an issue. We ought to be using these PPP funds and any of these lines of credit, and let's buy inventory in our biggest movers, because we think that that's an opportunity to seize. Well, guess what? That paid off in spades for them. So anyway, a couple questions that have just come in here. I agree. Papa Joe Farrell is on here. Thank you for reminding us that the chat, I think in the last upgrade in Zoom, the defaults, and we have not been able to figure out how to change the defaults in the chat feature, but I have to manually go back in there. So you reminded me again. Thank you. But his comment is, I think a gift tax discussion would be very interesting for people. I think you're right. And so Stephanie, be thinking about that. If you want to talk a little bit more about that, we could kind of tease that a little bit more today. But then also Bruce says yes to hearing Stephanie's comments on WSJ article yesterday related to regulatory IRA, estate changes, and inheritance tax obligations. So anything you want to expand on those two things, Stephanie?
Yeah, and I'll take them out of order. I'll talk about the Secure Act, the IRA changes first. So I have to admit, in 2019, when the Secure Act was passed, it was like a gut punch to me, because the Congress did a really good job of taking away one of our best estate planning strategies, which was the stretch of an inherited IRA. So just historically speaking, an IRA, once it was inherited, the beneficiary of the IRA was had the ability to continue to take required minimum distributions, or RMDs, from the IRA, but based on the beneficiary's remaining lifespan. So if I inherited an IRA from my father, I didn't have to inherit, I didn't have to keep taking required minimum distributions based on his life, which seems ridiculous since he's dead, but he still has a lifespan, an estimated lifespan. But I got to adjust the required minimum distributions for my life expectancy. Well, in 2019, when the Secure Act was passed, Congress said no more to that. And so it developed two groups of beneficiaries. Well, I guess really three: the 5-year rule beneficiaries, and that one just didn't change. What they called designated beneficiaries and eligible designated beneficiaries. And so everyone who was a designated beneficiary fell into this 10-year payout rule. The eligible designated beneficiaries were made up of the surviving spouse, who still gets to take advantage of the spousal rollover and the stretch for the surviving spouse's life. Minor children of the IRA owner, so it didn't count for like grandchildren, but minor children of the IRA owner. As long as they were minors, they didn't have to take RMDs, but once they reached the age of majority, then they fell into the 10-year bucket. They had to take distributions over 10 years. And then disabled or chronically ill individuals, and they also didn't have to take RMDs, or could use the RMDs for their lifetime. So going back to designated beneficiaries that fall under the 10-year rule, what the IRS told us in several publications that came out following the passage of the Secure Act was that RMDs did not need to be taken during the 10-year period, but that the entire IRA account had to be distributed to the beneficiary by December 31st of the year of the 10th anniversary of the decedent's death. So if the decedent died today, then all distributions had to be taken from the IRA by December 31st of 2032. Okay, so that's what we were telling our clients. And the interesting thing, and we were always telling our clients, once the Secure Act passed, was talk to your accountants and figure out when it makes sense for you to take distributions, because distributions from a traditional IRA are taxed as ordinary income. And so you don't want to take distributions from an IRA when you're in a higher tax bracket. Or maybe if you've maxed out your tax bracket, you want to take them then, but you probably don't want to take them. You want to wait until you retire, or you're in a cycle where you have your taxable income is less, so that your tax bracket is less. And so we were telling clients, you don't have to take the RMDs, but go talk to your accountants and figure out what the best distribution is for you, so that you take some of it in each year, you take some of it in year 5 and the rest in year 10, whatever works best for your tax situation. And like I said, the IRS came out with publications that confirmed this advice we were giving our clients, until the proposed regulations came out earlier this year. I believe it was in February. And all of a sudden, they said, never mind, you do have to start taking RMDs. If the decedent had been taking RMDs when they passed away, you have to continue taking RMDs for years 1 through 9 of that 10-year period. And then you have to take the balance in year 10. Well, that's not what the IRS had said previously. It's not what we had been telling our clients. And so why does that matter? Why does that present a problem? Because this guidance came out in 2021. And so we were advising clients about RMDs, or not to take RMDs, in 2021 or 2020, 2021. And when you don't take an RMD, it's subject to a penalty of 50% of the amount you should have taken.
Oh,
so
wow.
For example, if the RMD was $50,000 and you didn't take it in 2020 or 2021, well, I guess 2020, because of COVID, was a free year. You didn't have to take RMDs in 2020. So it only applies to 2021. If you didn't take an RMD in 2021, the RMD you were supposed to take was $50,000. You were required to write a check to the IRS of $25,000. And so, what were we telling our client? Now, what are we telling our clients? Again, this was sent out in proposed regulations by the IRS. And I'm sure everybody on this call is familiar with the fact that proposed regulations can stay proposed for a long time. I'm in my 18th year of practicing law, and there are regulations that were proposed before I started practicing law that are still in proposed form. So just because they're proposed doesn't mean how it's going to end up, and we don't even have like a time frame for when those will become actual regulations. So it creates a conundrum for us with our clients. What do we tell them about how to deal with those RMDs? It doesn't affect people who, when the decedent died, they weren't already taking RMDs. So if the decedent was 60, for example, and hadn't started taking RMDs, this is not, you still are under the 10-year rule. You just have to take it out, all of it out before the end of this 10th year. This only applies to people where the decedent was taking the RMDs at the time of death. In those situations, what we have told clients, and we've made them aware of this issue, we've advised them to talk to their accountants to determine what their RMD that should have been taken in 2021, what it would have been, and go ahead and take that if they qualify, and then go ahead and take RMDs for the remaining years of the 10-year period. We think that because the IRS published that you didn't have to take an RMD, there's reasonable reliance on that publication. And so that would give us a reason to argue that the 25% or the 50% penalty is not, should be waived in these cases. So we haven't litigated that. We haven't argued with the IRS about it, but that's what we're telling clients. So just hopefully that answers that question. But if you have any other specific questions about that, happy to answer. Gift tax. So gift tax is actually a state and gift tax. So everyone is able to make annual gifts and lifetime gifts. Annual gifts is the amount that you're able to give each person in the world on an annual basis. It's currently $16,000. And so you can make a gift to me, if you like, of $16,000 and not have to pay any gift tax on that. If you give me $17,000, you're going to have to send $400 to the IRS, because if you exceed the annual exclusion amount, any amount you exceed, the tax rate is 40%. In addition to the annual exclusion, which you can use every single year, and you can currently, this is something else we had heart palpitations about last year. I'm not going to go into that, but it was in that Build Back Better bill. But currently, you can make as many $16,000 gifts as you want to separate individuals. Everyone also has what's called a lifetime exclusion amount, estate and gift, and so they're contingent upon each other. It's one bucket that you either get to use during your lifetime or you get to use at death. With President Obama's Tax Act, he established a $5 million lifetime exemption amount, which is adjusted upward for inflation. In 2018, President Trump, as part of his tax act, just doubled that amount. And so a $10 million inflationary adjustment lifetime exemption amount. So for this year, 2022, we are currently at $12,060,000. When I'm talking about this for the rest of my discussion, I'm just going to say 12 million, because to me, the $60,000 is a rounding error. It should just have been 12 million. I'm not being imprecise, but the amount of time it takes me to say the extra $60,000, we're just going to alleviate that. So $12 million for 2022. So if you pass away in 2022, you are allowed, or you can have your estate can be worth $12 million without paying any estate tax. If it's $13 million, your estate, the executor of your estate gets to write a check to the IRS for $400,000, because again, the tax rate is 40%. The $12 million is always going to be free. The tax is only assessed on the amount that exceeds the $12 million. There's also this concept of portability that only works upon death. But if I die and I haven't used any of my $12 million, my husband can reach over and grab my $12 million and take it as his own. Then he has his 12 million plus my 12 million, which is why for married couples, they're only going to pay estate tax if their total estates exceed $24 million. To the extent that you make lifetime gifts during your lifetime over the annual exclusion amount that I talked about a minute ago. So for example, say you wanted to give me $100,000. You would use your lifetime exemption amount. It would be reduced from 12 million to 11,900,000, because you would use part of your exemption to the gift that you made to me without paying any tax on it. So that's how the estate and gift tax works together during your lifetime. So how we're currently scheduled under the exemption is that it will increase $12 million, increase next year for inflation the next year until December 31st, 2025. And then when you wake up January 1, 2026, you're going to be less rich than you were, because now you're going to have to start paying estate taxes, because the estate tax exemption is going to go back down to $5 million adjusted for inflation. And so we don't really know what the inflation adjustment is going to be, because we don't really know what inflation is going to do. But I think most reasonable minds are predicting that it will be between $6.5 million and $7 million will be the new exemption amount starting in 2026. So I don't know how much more Joe wants me to talk about that, but that's kind of a primer in gift tax issues.
Yeah, I think, maybe what you could hit on, Stephanie, is that, a lot of people think, it's not a big problem, for me, because I don't have that taxable of an estate. So maybe talk about, kind of prognostication around, as you pointed out, it's done soon. Like when it passed, soon seemed like a long ways away, because it changed in 2017. So, soon, it's way out, and of course we'll fix something by then. I don't see something getting fixed to make this level permanent, as you pointed out. So talk about what happens if you give a gift like in this level. Like, again, hypothetically, you've got, a $40 million taxable estate, and you utilize exemption that will have expired under the new law.
Right. So there, to your point, there's an anti-clawback provision. And so there's two things I probably need to mention about that. So if you make a gift this year of $12 million, and when you die, after 2025, and your exemption, the exemption amount is only $7 million, you get credit for the amount that you used. There's no clawback to say, yeah, well, you used 12 million, but now you've died and it's only 7 million. And so you have to pay tax on the additional 5 million. There's a very clear revenue ruling that says there's not going to be a clawback. So once you use it, you're good. In addition to that, once you port if your spouse passes away and you grab your spouse's unused exemption amount, once you have that, they don't take that away either. So your exemption amount, it may go up or down based on what the law is, but the exemption that you grabbed from your spouse's estate stays the same. So if my husband dies this year and I grab his $12 million, I keep that $12 million. And if I die in 2026, when the estate tax exemption is $7 million, I have a total exemption of 19 million. So his 12 plus my 7. And so the only time I would pay my estate would pay estate tax is to the extent that my estate, when I die in 2026, exceeds $19 million.
Yeah, that's helpful. That's good stuff. we may, it may be worth bringing Stephanie back. We'll have to kick Jack to the curb again, but
I'm wearing dark blue next time, boys. I'm just gonna tell you, I'm wearing dark blue.
I'll wear purple, and then we'll be in between there. Derek had a question. So what's the risk of untaxed retirement cash flow vehicles, thinking whole life, but there may be others, being revised in this or future legislation, or will the changes primarily be focused on a very limited number of companies and taxpayers?
I feel like with that one in particular, it gets in the category of, what are they talking about here? I've got a whole life policy. It's accumulated, a cash surrender value that's in excess of the premiums that I've paid. So I've actually made some money on the deal, and, for me to do nothing with that, they would have to pass something that says that holding gains are taxable. And I just, maybe they'll do that at some point, but they'd have to be like, it's going to be at a pretty big bar, I think, before that phases in. I want to say it was like 10 million AGI is what was bannered out there in terms of taxing held gains. The second component of that is that, when they talk about it being tax-free, what's actually occurring is that you built up this big value, and then instead of just withdrawing money from the policy to live off of, you take a loan against the policy and live off the loan proceeds. So your balance stays intact and you're just living off a loan against it. Man, I mean, they could do something to life insurance on that, but you can replicate the same strategy with an investment account. So you would have to go over every line of credit that's been established against every investment portfolio. Like when people hear about Jeff Bezos not paying taxes, that's how Jeff Bezos is not paying taxes. So you'd have to go over every single, to be fair, you'd have to go against every single loan feature that's in existence related to borrowing money against an asset. And then you would get into, well, what about equity in real estate when I do an equity loan against my commercial real estate portfolio and live off of that? Like, how's that any different from the whole life policy? So they might do something, but I find it highly unlikely because it would be so fraught with unfairness everywhere else, that exists.
And I know this is not the question Derek asked, but one thing to remember when you're looking at estate planning and what, like especially estate tax planning, a lot of clients don't think about this, is that the death benefit of life insurance policies that you hold in your own name are included in your gross estate for estate tax purposes. So you may have said, Stephanie, I heard all you said about the $12 million exemption. I only have $7 million, so I don't need to worry about that. But if you have a $10 million policy, now you have an estate tax problem, right? Mm-hmm. Because it's the $7 million of the assets that you think about and the $10 million of the death benefit of life insurance policies that are added together to calculate your gross estate for estate tax purposes. So anytime I hear any thing about life insurance, I always want to mention that, because I think a lot of people just either don't realize it or don't think about it, because it's not usually something we think about as an asset. So
yeah, that's good. Well, we are rounding the corner and heading to home. I know it's not a soccer analogy, but so we're doing a breakaway, and I'm gonna launch the poll for y'all. So we'll see, and maybe if anybody, first of all, let's just see how people vote. So I'm going to go ahead and launch this poll. Charlotte FC's secret to defeating DC United 3-0 last night. So how did they do that? There are 4 answers. Charlotte FC played better. Yes, they did. Charlotte FC has an awesome crowd. Absolutely, they did that. I was told, I think Derek may have mentioned this last night, that Chelsea, their team mentioned about how good the fans were and that it was an electric venue. I think we had 50-some thousand in that venue for Chelsea. It was kind of fun. DC United is anything but united. I think that is perfect. That's actually my favorite of the answers. Oh man, yeah. DC is not a united place. And I don't know that it ever has been, but man, is it divided now. And all of the above. So good move on everybody's part on that one. I'll share the results. There are the results. So, and I know that Jack had some Starbucks giveaways that we didn't have anybody get the right answer last time. So when Jack comes back, hopefully he's got his pockets full of free giveaway Starbucks cards for anybody that pays attention. So we will put this broadcast up on the BGW CPA YouTube channel later on this afternoon. Thank you, everybody. And a special thank you to you, Stephanie. It's always good to have you on here. And, you know, that's a good thing.
Thank you. I enjoyed it. Thanks so much.
And Adam, it's good to have you back too.
All right, cool. See you guys.
All right.
Thank you, Stephanie.
We'll see y'all.
All right.
Have a good
All right,
rest of
see
the
you. Bye.
week. All right. Bye-bye.